Consensus forecast for the U.S. economy continues to be a soft landing, some slowdown in economic activity, but no recession. Some forecasters are even saying no landing, meaning the near 3% recent GDP growth rate will continue. We aren't convinced, as the incoming macroeconomic data appears to be at odds with the less aggregated data, surveys, and sentiment. For example, recent retail sales in September indicated rising consumption of food away from home at restaurants. That's in stark contrast to the headline on the front page of the October 22nd Wall Street Journal, and I quote, "Empty tables, high costs push restaurants into bankruptcy." This year, apart from 2020, restaurant chains are on course to have the most bankruptcy in decades. The list of restaurant chains declaring bankruptcy in 2024 include Red Lobster, Hawkers, Asian Street Food, and Tijuana Flats. There's 13 restaurant companies that are either publicly traded or have $10 million in liabilities have filed for bankruptcy so far in 2024. That's up from 4 in 2023. And that's only one of several indicators that are at odds with macroeconomic data. Last month's non-farm payroll, plus 254,000 in jobs, is another. Taken at face value, that number would appear to indicate that the job market is quite strong. But broken down, government jobs grew 785,000, and that leaves the private sector with a 531,000 loss. Other recently released data also indicate that the economy is slowing. As shown on the chart, industrial production has been flat or negative since early 2023. The Richmond Fed's manufacturing index was negative in October, and that index has been in negative territory for 12 months in a row. The Kansas City Fed's manufacturing index also showed contraction in September and October. In addition, the Chicago Fed's National Activity Index, that's a comprehensive index of 85 national variables. That index showed up negative in September and has now been negative for 4 months in a row. To say the industrial economy is in recession appears to be quite an understatement. It's a similar story for housing starts. They're below 2021 and 2022 levels and have been below them for the better part of the last 2 years. Worse, building permits, that's a leading indicator of new housing starts, have also stagnated. And that's likely due to the uptrend in rental vacancy rates. Existing home sales were also down, and that number fell 1% from August to September, and over the last 12 months is down 3.5%. September sales were at the lowest monthly level since October of 2010. On the front page of the October 24th Wall Street Journal, the headline read, quote, "Falling home sales are on track for their worst year since 1995. Such sales have been on the decline since 2021, no doubt due to the rapid rise in interest rates engineered by the Fed. For the month of September, median home prices fell 2.3% and have now fallen for 3 months in a row. And time on the market increased to 28 days in September from 21 days in September of 2023. This could be a sign that home prices are peaking for this cycle. Let's hope so. The Conference Board's leading economic indicators showed up at a minus 0.5% in September from their August levels. This is the 7th consecutive negative reading. The index is down 4.8% from a year earlier, and as shown on the chart, the year-over-year percent change hasn't been positive for 2 years since mid-2022. The coincident economic indicators are still showing up as positive, plus 1.4%. And while that means that the economy is still growing, the leading indicators indicate that the future road may be rocky. Here's some food for thought. In January of '08, the leading indicator was minus 4.9% year over year, quite similar to today's minus 4.8%. The coincident indicator was plus 1.5%, again like today's plus 1.4. What happened next? The Great Recession. Further back, in February of '01, the leading indicator was minus 5%, and the coincident was plus 1.7%. Again, a recession was not far off. We are currently midway through the quarter 3 publicly traded corporate reporting period. Given the 2.8% GDP growth, one would think that the U.S. companies are doing well. But there have been some negative surprises. Starbucks, for example, a bellwether of the American consumer, reported that their sales were down 7% from the same quarter a year ago, and they suspended their guidance for 2025. Hilton lowered full-year profits and revenue, and they cited softness in travel demand. Coca-Cola saw a 1% year-over-year sales decline, quite unusual. Sales at Gucci stores are off a whopping 25%. Winnebago cited weak RV sales. Volvo indicated their lower sales, and they cut their full-year guidance. Even beer maker Heineken cited weaker sales. And Discover Card said that card transactions were 3% lower than a year ago. So it wasn't a big surprise to us when in mid-October, Goldman Sachs updated their long-term forecast for U.S. equities to an annualized return of 3% per year over the next decade. That's an annual growth forecast that would put that in the next decade of stock market growth into the lowest 10 percentile of growth by decade since the 1930s. Compare that 3% growth rate that they're forecasting to the 13% per year growth over the last 10 years. The S&P is up more than 22% so far this year, and it's up 40% from a year ago. While growing corporate earnings justifies higher stock prices, those earnings are only growing 5 to 6% per year, hardly justifying 40% higher stock prices. The price-earnings ratio, which is a proxy for earnings growth, now sits north of 22 times. Its long-term average is around 16 times. Looked at from this perspective, Goldman's forecast is that a 40% increase in the S&P 500 index that has happened over the past year will take another 10 years to replicate. Whether that happens at a slow pace or via a market correction is anyone's guess. But what it does say is that bonds, now yielding more than 4.25% for the 10-year Treasury and 5.25% for 10-year A-rated corporates, are likely to outperform equities over Goldman's 10-year horizon.